please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Let's shift our attention to another important announcement that came from the government. The government announced that every single village in India has now access to electricity. But more importantly, it's the definition of village. Electrification of 10% of the village is considered having electrified the village. So while it is 100% electrification for villages, it is only about 83% electrification for households. That is, even if they get 1 hour electricity, it's considered that the household is electrified. So what is the Power Minister got to say about getting that access? Our colleague Rituparna spoke to the Power Minister, R.K. Singh. Listen to what the Minister had to say.
We have reached every census village. Right. That's what we have done. Right. Now, for 100% electrification, we will have to connect every household. Yes. Yes. Which we plan to do, which our target is that we do this by the 31st of December 2018. Right. It's a huge target. The states have reported that there are 37 million households which have not been connected with electricity as yet. Imagine, 71 years after independence, you still have 37 million households not connected with electricity. We have to connect all that. Up till now, we have done about 50 lakhs. Right. But we have a huge amount of ground to cover.
But from now till December, it is within that period of time that all these houses will be electrified. Yes. So how are we going to do it? What is the strategy going to be like?
You see how we have worked it out, and this is something which we have worked out with all the states in discussions here, and then we go to the states and discuss it with their minister, the chief minister, and the principal secretary and the CMDs of discoms. So we've done this in discussions with the states, and we have refined strategies. So the teams have been formed.
Okay, well, those are live visuals of the HCL Tech management. They're going to kickstart their press conference any minute now and tell us more about that guidance that the street is disappointed with. But in the meantime, sources tell CNBC TV18 that the SR Steel lenders will be meeting ArcelorMittal and New Metal today. Ritu Singh has all the details for us. Ritu, over to you.
That's right. Both the bidders of SR Steel, that is Arcelor and New Metal, will be making their presentations to the lenders and the Committee of Creditors meeting today on what exactly their offers are. We'd reported last week that ArcelorMittal's offer was far higher than what New Metal had offered. But that said, both of them are currently ineligible under Section 29A of the IBC. Therefore, both of them, as ordered by the NCLT, will have to be given time to cure their defects. So after today's presentations, the lenders will give them their comments and order, so to speak, on what exactly has to be cured for both of them to be eligible under Section 29A. What we understand from a conversation with the bankers is that while ArcelorMittal will have to repay all of the dues of Uttam Galva Steels and KSS Petron, which is over 7,000 crore rupees, for New Metal to be eligible as per the consortium that has submitted the bids, they will have to repay the entire SR outstanding. That could run well over 60,000 crores if they are to be eligible. So that is a tall ask, and it is possible that under this, New Metal may again challenge this order by the lenders. But that is something that remains to be seen. They will be given 7 days to cure the defect and come back with whether or not they're eligible for the lenders to consider their offers.
Fair point. Thank you very much. So ArcelorMittal may have to pay up some 6,000-7,000 crores, and New Metal will have to pay up 60,000 crores probably, or 45,000 crores to become eligible. Let's see. Today it will only be a postponement, but here is HCL Tech.
For the year, continuing predictable and consistent track record of performance. In fiscal 18, our revenues grew 12.4% in reported currency and 10.5% in constant currency. Our Q4 revenues grew 2.5% in reported currency and 1.2% in constant currency. Our EBIT for FY18 stands at 19.7%, and for Q4 it's at 19.6%. Our Mode 2 revenues grew 29.4% in FY18 compared to FY17. Our Mode 3 revenues grew 68.3% in FY18 compared to FY17. In terms of deal wins and business momentum, we signed 15 transformational deals in Q4, representing a well-balanced mix of our services, geographies, and verticals. Overall, the deal wins for the full year stands at number 63 transformational deals in the financial year. Our Mode 2 and 3 services on a combined basis now constitutes 23.4% of our revenues, up from 18.6% from last year. in all our Mode 2 services, we continue to see expansion in deal sizes and the number of deals. Customers and our clients have moved on from proof of concepts and looking at projects which are innovative in nature to really scale digital programs, really bringing in the capabilities of all our service lines to a benefit of our clients. If you look at some proof points, we have over 500 clients for whom we deliver Mode 2 services today. And we have 26 customers with over $10 million of revenue in FY18, contributing to about 49% of our Mode 2 revenues in FY18. This is reflective of the number of deals and the scale of our next generation services. Our existing clients and the prospective clients are considering us to be a disruptive vendor in their scale digital journey to replace some of the traditional vendors. In Mode 3, we continue to invest in internal IP creation as well as build IP partnerships and also make strategic acquisitions. In this quarter, we filed 20 patents in various next-generation technologies and platforms, including artificial intelligence, automation, machine learning, data analytics, and simulation areas. In FY18, we filed the total number of patents was 75 patents. In FY18, we expanded our IP portfolio. We also launched our first wave of managed services edition of some of the products that we brought to the market. We continue to look at acquisition as an integral part of our growth strategy. Last month, we announced 2 acquisitions, C3I, which is a life sciences and consumer packaged goods customer engagement services provider, really to help us gain access to more vertical and niche capabilities in that segment. We also announced the acquisition of C3I, which is a hybrid data management provider, we signed a definitive agreement to acquire Actian along with Sumeru Equity Partners, again to help us evolve and continue to invest in some of the new technologies. In terms of our overall growth, our infrastructure services grew 2.5% quarter-on-quarter and 4.5% year-on-year. Our engineering and R&D services grew 1.7% quarter-on-quarter. In FY18, engineering services posted 37.6% overall growth, and this has been fueled by our engineering offerings, IP partnerships, and some of the acquisitions. Our application services degrew this quarter by 0.9%, but which is on the back of a good momentum over the last many quarters, and on an annual basis it grew 4.4%. Our BPO services grew 5.3% quarter-on-quarter and 0.9% year-on-year, largely driven by robotic process automation and digital ops engagements. We continue to, in terms of geographies, Americas degrew 0.7% quarter-on-quarter, but that's again on the back of a very strong growth over the last many quarters, including in FY18 a growth of 13.8%. Europe grew 3.6% sequentially and 5% from a year-on-year perspective, and while rest of the world grew 8.1% quarter-on-quarter and 6% year-on-year.
Talk about the telecom sector now. It's in focus on a buzz of a slew of reforms, including an ombudsman for the grievance redressal that is on the anvil. Ashmit Kumar has all the details for us. Ashmit, over to you.
And so the much-awaited national telecom policy is here. It got uploaded late last night for public comment as of right now. The broad contours, as far as the goals that it has set for itself, it's calling itself the 2022 goals. Goals include the likes of attracting investments of over $100 billion. It also talks about how taking broadband to every household, that's another key target that they've set for themselves. Ensuring that there's a data protection regime in place under the current system. These are the broad contours, these are the broad 22 goals that they have set for themselves. But as far as the specifics are concerned, and here's what's interesting, as far as catalyzing investments, that's one key focus area of the national telecom policy. It talks about reviewing various levies, including the license fee, including the use of, in fact, rationalizing the SUC. That's something that, in fact, the industry had been pitching for. The NTP clarifies that that's going to be the way forward. It also talks about rationalizing of various taxes and levies on digital communication equipment. So a number of moves being contemplated here for catalyzing investments. 5G is the next big thing. For that, the NTP envisions rolling out an action plan, making enough spectrum available. It also talks about making in India, in terms of rationalizing of taxes and levies, and differential duties to incentivize local manufacturing, attracting global OEMs, and the big players, the reference one imagines is to the likes of Apple and Samsung. So that's one major target that they're setting for themselves. The national telecom policy also talks about liberalizing the spectrum sharing and leasing trading regime. So a number of moves being contemplated here, and all of this, of course, keeping in mind the fact that issues such as consumer grievances by way of establishing an ombudsman, establishing a data security regime. So these are also aspects that the NTP looks at. So a comprehensive overhaul is what the NTP is envisioning.
Okay.
The answer would be how telecom guys respond.
Yes, Ashmit, thank you very much. We will, of course, dwell in detail after market hours. But for the moment, for the market itself, the question will be, where will the money come from? Rajan Matthew, Director General, COAI, joins us on the phone line. Good morning, Rajan. Thanks much. You know, that will be the most troubling question. I mean, telecom companies, one after the other, are actually reporting losses. Where will this $100 billion investment come from?
I think that is the question of the hour, to say, look, given the present financial condition of the sector, the fact that NTP 2018 has recognized this and said that let's make sure that the components of getting the industry back to health, which is addressing spectrum charges and costs, addressing the whole issue of license fee, which we believe is a doubling up of costs, the whole issue of spectrum usage charge. These are critical issues that we said if the government address those, the industry will slowly get back on its feet. And overall, I think the policy direction which says no longer should the industry be seen as a revenue resource, but more as a development resource. I think that change in focus of the policy, I think, is very, very welcome. And if that happens, I think we will have an easier time attracting the $100 billion plus that will be necessary to get the industry going in the right direction.
Okay. Mr. Matthews, good morning. What about the proposal to set up an ombudsman? What would your reaction be to that, and how feasible do you think that could be?
We clearly support the issue of ensuring that customers are satisfied in terms of the resolution of their problems. The question with regards to the ombudsman issue is the fact that we think that it may be leaning more towards the bureaucratic area of a solution rather than a more efficient way of doing a solution. So saying that there will be an ombudsman, right now there is a present two-tier system. And please understand that the amount of money involved, you know, when you have 95% prepaid folks who have balances or who spend upwards of 100, 150 rupees, those, you know, by the time you set up an ombudsman, where do these people go? Is it an online resolution system? What are the costs involved? So nobody has really done a cost-benefit analysis of putting this through. I think that is essential to determine before we begin implementation.
All right, that point is taken. Mr. Matthew, we will meet later on in the day to discuss this policy in detail. In the midst of market hours, it's important to know that perhaps, as the industry's voice is saying, there would be a rationalization of license fee and universal service obligation charges so that the industry can find the money to invest in to meet the obligations of the telecom policy. Well, let's come back to markets and to one of those sterling numbers that came in. Dabur posted a good set of numbers in the fourth quarter. Volume growth in line with estimates and actually better than several previous quarters. Adjusted revenue, EBITDA and profit were all a beat on expectations. Sunil Dugal, CEO Dabur, joins us now. Good morning, Mr. Dugal. Thanks much. Well, first up, this volume growth, that's particularly impressive. Do you think it can be better, considering that your early quotes indicate that you're seeing improvement in rural demand?
Yes, there has been some improvement in rural demand. We're seeing some uptick in the month of March. Hopefully it will accelerate. But the reality is that category growths in at least the core HPC categories, home and personal care categories, are still trending at around 5–5.5%, which is quite frankly not good enough. Now, we've managed a beat this time. We've done around 7.5–8%. But to get into the double digits which we so desire, I think the category growths have to revive and accelerate further. There's every evidence of that happening, and we do hope that given a good monsoon and other stimulus which we expect, the category growths would rev up to maybe the high single digits, in which case we can then again do a beat and get into the double-digit growth numbers perhaps from the first quarter onwards. But early days, I think at the moment it's not very high in terms of the category growths, but trending up a little bit.
Okay, so in the first half of FY19, should we still expect single-digit volume growth in the domestic FMCG segment?
Well, we'll hope to up it to the very high single digits, maybe low double digits. But at this point in time, I would perhaps say that 8 to 10% growth in the first half is something which we do anticipate. Now, going forward into the second half, there will be the whole issues of monsoon and stimulus, etc., etc. But 8 to 10% is still what we will guide for the first half.
Okay, so that's 8 to 10% volume growth for the first half. Wanted to ask you about the gross margin expansion, because the last time you had indicated to us that, you know, your promotional expenses have gone down and that will result in an expansion in gross margins. But is that a trend that is sustainable?
We expect gross margins to trend at current levels in the first half. The visibility in terms of inflation and all is pretty much there. So we've got our covers booked for the raw materials. So I think it will be pretty stable in the first half. And second half, again, it depends upon how much inflation will hit. We do believe that we have pricing power to neutralize inflation. So I don't see margins trending down even the second half, but there may not be much possibility of improvement in margins. Remember that we are already sitting on historically high margins, so growing on that is not going to be easy.
You know, you're guiding for 8 to 10%, and look at each of the individual categories. Vatika, 31%, honey sales plus 24%, toothpaste 14%, led by Dabur Red, which is actually 20%, healthcare growth 11%. Is Patanjali threat now a history?
Well, I think the erosion of market share would happen basically in honey, and I've been saying that for the last few quarters. That has been now mitigated, and we are now back to our erstwhile market shares, and we do hope to even grow on that, because the acceleration in honey, as you've seen in the last 2 quarters, is very high. So I would say that the downsides which happened on account of the competitive issues are now largely behind us. And the key challenge is that the category growth revives so that we can ride on that and grow faster.
Okay. So is it fair to assume that there won't be higher promotional expenses in order to defend market share?
Well, there'll certainly be higher advertisement expenses, and if the category growths remain tepid, then there would be acceleration in terms of promotional growth also, because that typically happens when the growths are not there in the environment. So it's early days yet. Let's wait and watch and see how the category growths revive.
You said that the distribution network got broken because of GST and a whole host of things. And then you all even spoke about direct distribution. Is your network in place or will that yield the higher sales?
Well, it already has. You've seen the last 2 quarters or even the last 3 quarters performance, including this one, and the growths have been pretty decent. That wouldn't have happened had we not totally re-architected our distribution, particularly in rural India. And that's what's led to these gains. Now, going forward, I think it's pretty much in place. Some improvements, of course, and fine-tuning required. But this will certainly help our rural growths to outperform the urban growths. Even this quarter, you've seen rural growths at around 3-4% higher than urban. And this trend will continue.
The other thing that the street has really liked, Mr. Duggal, is the way your international business has grown. Revenue growth in double digits for the first time in 6 quarters. Is that a trend that is likely to move further?
I believe so. The performance, of course, this quarter was outstanding. 18% or 17% top line, 34% bottom line growth in the international business. This may not be easy to maintain because this is off a little bit lower base, but I still see for the balance of the year strong double-digit growth emanating out of the international business. And the quality of this growth is good because our high-margin MENA businesses are now growing at a very fast pace, and the lower-margin businesses are not growing as much. So that's why this has led to this sharp acceleration in our profitability. So I think that's the big turnaround, and that's perhaps the biggest highlight of this quarter is the turnaround in the international business.
Actually, I was going to ask you a little more about the MENA region, Middle East and North Africa. You know, that's now richer because of the price of crude. As well, you're getting a rupee advantage. So can you really be surprised on the upside because of this twin tailwind?
No, we did expect it. So I'm not saying I was really surprised, but it's still good to see the growth coming back. Saudi Arabia, which is our biggest and most profitable market, grew by 81%. And that really improves the whole quality of the growth because the high margins which we realize from the market. Even the lower Gulf markets, North Africa to some extent, Egypt in particular, has done extremely well. So while there are pockets of pain, particularly in the most strife-ridden areas of that particular region, Algeria, Libya, Syria, of course, nevertheless, the growths in aggregate terms have been good. And so is Sub-Saharan Africa. Turkey growths are also good. So it's been a secularly good performance. Pakistan has performed well.
Okay.
So has Nepal. So we're pretty happy with the way things have gone there.
All right.
Okay, let's make a check on the commodity space, where we have seen almost all the sectors open in the positive today, starting with the crude oil prices, where we did see the prices decline 2% and hit a 2-week lows. But Asia has seen some buying come back, and this is on the back of concerns that you could see sanctions being introduced on Iran by US yet again, and that premium really seems to be building right now. Add to that the kind of statements that have been coming in from Israel that Iran could be secretly building up nuclear weapons is something that has led to money come back in case of longs in crude. So 0.5% up is what we are trading on the MCX as well. It's taking direct cues from what's happening in the international markets there. The gold and silver prices, well, yesterday wasn't a strong day at all. We saw the gold prices go down to a 2-month lows, and the silver prices were down by a percentage point as well. But $1,300 per ounce has held on for the gold prices, and that is where you have seen some opportunity buying come back into that space. So 0.25% up for gold and a percentage point up for silver is how we are trading. Remember, these markets are awaiting the US Fed announcement today late in the evening. Further direction for this one would come in from there. But the base metal prices also have seen some buying come back. China is back into participation after a 4-day-long weekend, and we have seen buying come back from those markets. Also, apart from that, there is expectation that the China demand for this quarter is going to pick up. We also have seen reports on how especially zinc and lead will see deficit in all of 2018, but it really is the nickel prices which are outperforming all of that pack, and that's because the steel prices are up 2%, iron ore is up 1.5%, and the steel ingredient nickel seems to be doing the best at this point. Trading strategies, and we have them from Angel Commodities. They have a buy call continuing for nickel. They're looking at an upside of 935 onto that one, but they have a sell call for the energy products, and natural gas is where they're expecting the prices to decline up to 182 rupees per MMBTU for the day today.
Okay, thank you very much for that summary, Manisha. Well, as we wind down on Bazaar, the indices are flat.